All right, today we're diving into a true giant of finance, Burton Malkiel's A Random Walk Down Wall Street. For decades, the core message of this book has been both incredibly simple and, honestly, pretty radical. It challenges the very way most people think about investing. So let's break down that timeless wisdom.
But first, let's start with a question that I think gets to the heart of it for so many of us. Does investing sometimes feel like just a big, complicated, high-stakes guessing game? I mean, you're constantly bombarded with hot stock tips, so-called expert predictions, complex charts, and it's just so easy to feel like you're lost before you even begin.
It really is like trying to find your way through a maze, right? Full of dead ends and confusing turns. You hear about some sure thing from one person, and then a scary warning about a market crash from another. All that noise, it can be absolutely overwhelming. So think of this explainer as our map. It's our attempt to find the simplest, straightest path right through the middle of that maze.
Okay, Section 1. A Random Walk Down Wall Street. We're going to start with the simple truth that sits right at the very heart of this book.
So what on earth is the random walk theory? Well, Malkiel's big idea is that the market's day-to-day movements are, for all intents and purposes, random. And the reason is actually pretty simple. Prices react instantly to new information. And new information, like a surprise earnings report or a sudden world event, is, by its very nature, unpredictable. So if tomorrow's news is a surprise, then the market's reaction to it has to be a surprise too.
And the implication of this is just huge. If those price movements are random, then trying to consistently guess what a stock is going to do next week or next month, it's basically a fool's errand. Look, you might get lucky once or twice. Hey, you can guess a coin flip correctly, right? But you can't build a real, reliable strategy on pure luck.
Section 2, why you can't beat it. Okay, so if the market is random, what's the science behind that? Let's take a look under the hood.
It all comes down to something called the efficient market hypothesis, or EMH. This theory basically says that at any given moment, a stock's price already reflects all the publicly known information about it. Every quarterly report, every news article, every analyst rating, it's all in there. This means by the time you hear that hot tip, guess what? The market already heard it, processed it, and baked it into the price.
Just think about what that really means for a second. If all the information is already priced in, it becomes almost impossible for any single person, doesn't matter if it's you on your laptop or a superstar fund manager on Wall Street, to have a consistent, lasting advantage. The information game, well, it's already over.
So this really presents us with a choice between two very different investor mindsets. On one side, you've got the active trader. They're always chasing, always trying to predict and outguess the randomness, and it's a path that usually leads to high stress and, you guessed it, high fees. But on the other side, you've got the random walk investor. They accept the randomness. They follow the market with discipline, and they focus like a laser on the one thing they can control, keeping their costs way, way down.
Section 3. The simple path. So, if trying to beat the market is a losing game, what does the winning one look like? This is where Malkiel offers a strategy that's not just simple, but it flows directly from the science we've just been talking about.
The answer to getting through that maze, to getting off that emotional roller coaster of guessing and gambling, it isn't some complex hidden secret. It's actually a science-backed, proven strategy that's been hiding in plain sight this whole time.
The solution is the index fund. Seriously, instead of trying to find that one magic needle in a giant haystack, an index fund just buys the whole haystack. By holding all the stocks in a big market index, like the S&P 500, you're not betting on one company anymore. You're betting on the long-term growth of the entire economy.
And the data year after year just proves this out. Over the long haul, a simple, low-cost index fund consistently beats the majority of those expensive, actively managed funds. And why is that? It's because while the so-called experts are burning money on fees trying to be heroes, the index fund just quietly matches the market's return for next to nothing. It turns out, not trying to be the hero is the most heroic move of all.
All right, last section, your timeless investing playbook. Let's boil all of this down into some simple, clear rules for long-term success that you can actually use. First, let's talk about what not to do. Malkiel is crystal clear about the traps that just destroy wealth. Things like getting suckered into short-term gambling, thinking you're smart enough to time the market's ups and downs, getting overconfident, and the biggest one of all, letting your emotions, fear, and greed call the shots. These are the unforced errors of investing.
So what should you do instead? Well, the core takeaways are basically the exact opposite. You need to focus on a time horizon of decades, not days. Diversify, so you own a piece of everything. Obsessively, and I mean obsessively, keep your fees low, because every dollar you pay in fees is a dollar that isn't working for you. And finally, the glue that holds it all together. You have to maintain emotional discipline. And this quote just says it all, doesn't it? You can read every finance book in the world, but all that knowledge is completely worthless if you panic and sell everything when the market dips or get greedy and pile in at the top of a bubble. In the end, your own behavior is the biggest factor in your success.
So I'll leave you with this final thought. We're always told that making money has to be exciting, complex, full of action. But what if the exact opposite is true? What if the most effective, the most proven, and the most profitable investing strategy you could possibly have is, well, wonderfully, refreshingly boring?